Marvell Technology is absolutely dominating the headlines right now. I mean, if you've been following the semiconductor space at all, you've seen the massive analyst upgrades, right? Market sentiment is just rapidly turning bullish on their AI networking demand. But, as we always say, headlines only tell a fraction of the story. So today, in this explainer, we're going to break down the actual data. We're stripping away the noise to look at exactly what's driving all this momentum.
Okay, let's dive into this. The entire conversation surrounding Marvell right now basically boils down to this one massive question. Are they actually the undisputed king of custom silicon? Or are they, just riding the coattails of this massive AI interconnect wave? This is the core debate that's sparking all these analyst upgrades. And it gets even more fascinating when you start seeing the head-to-head comparisons between Marvell and an industry giant like Broadcom. So who really wins in this space? That's exactly what we're going to figure out today by weighing both sides of the argument.
So, let's kick things off with Section 1, the bull case. To look at this objectively, we're going to use our scales of justice framework, and we're starting with why the market is suddenly turning so incredibly bullish. There are essentially three fundamental pillars of strength holding up Marvell's current valuation, and guys, they are rock solid. First up, the AI interconnect market is just absolutely booming. Marvell is the one manufacturing the optical DSPs and Ethernet switches that literally physically connect thousands of GPUs inside these massive AI data centers. I mean, this is the hardware that makes AI possible at scale. Second, we've got their design win momentum. Marvell isn't just out there pitching ideas. They're actively securing custom ASIC deals with the absolute biggest hyperscalers on the planet. We're talking Amazon, Google, Microsoft, the big leagues. And third, all these deals are leading directly to expanding gross margins. These aren't just little short-term trial runs. These are massive, long-term, high-margin contracts that lock in very real, predictable revenue for years to come.
And that brings us to a really crucial point. This isn't a story stock. It's a story with revenue. In the tech sector, right, it's so easy to get caught up in companies that are operating entirely on hype, constantly promising that profitability is just right around the corner. While Marvell is completely different, because they're the ones currently supplying the optical DSPs and switches connecting all those data center GPUs. They're generating real cash flow right now. They're cashing in on the current AI boom today, not just projecting it for some distant tomorrow. And this brilliantly illustrates that financial impact. Marvell's gross margins are expanding toward this massive 60% plus threshold. Now, how are they actually doing it? Well, by executing a very deliberate, very smart pivot. They're actively shifting away from producing those lower margin commodity storage chips, and they're redirecting their focus entirely toward high-value networking and custom silicon. This 60% plus number, it's the direct result of focusing on the absolute most lucrative sector of modern tech infrastructure.
All right, let's flip it over to Section 2, the bear case.
To truly understand the landscape here, we have to flip the coin, balance out our scales of justice, and really examine the inherent risks hiding just beneath the surface. And the first major red flag, it's the valuation. When we look at the forward PE, Marvell is sitting at a very stretched 35 to 40 times earnings. Compare that to the broader semiconductor average, which usually hovers right around 25 times. So what does this actually mean? It means the stock is essentially priced for perfection. As an investor buying in at these levels, you're basically paying a massive premium for a promise. And as the market loves to remind us time and time again, promises can break. If their growth slows even a tiny bit, that multiple leaves a whole lot of room to fall.
The second massive hurdle in this bear case is the competition, specifically Marvell versus Broadcom. Look, yes, Marvell is doing an incredible job securing those hyperscaler ASIC deals and really expanding their footprint. But Broadcom is the 800-pound gorilla in the room. They have unparalleled scale, deeply entrenched relationships, and a significantly larger foundational AI revenue base. To put it simply, Marvell is certainly winning some very impressive battles right now, for sure, but Broadcom is currently winning the war. They are a formidable roadblock to Marvell taking that absolute top spot.
Now, what's really interesting about the slide is how it visualizes the timeline, because honestly, this might be the biggest risk of all. Look at 2024 and 2025. Marvell is enjoying that interconnect revenue and securing those ASIC deals, which is great. But look out to 2027 and 2028. That's when the custom silicon revenue actually matures and becomes a real catalyst. Do you see the gap? Right smack in the middle is 2026, which represents a massive AI capital expenditure slowdown risk zone. Those big hyperscaler design wins are fantastic, but the actual major revenue from them is years away. So if the broader market's AI spending slows down before that 2027 revenue actually materializes, Marvell's stock is going to take a very serious hit. The momentum is undeniably strong, but so is that timeline risk. Let's move right along to Section 3, the technical setup.
So now that we really understand the fundamental narrative driving the company, both the good and the bad, let's step away from the story for a second and just look at the cold, hard technical data. We need to see where exactly the stock stands today. We've got a clear resistance zone sitting right between $100 and $105, and a really strong support zone established between $85 and $88. Now, right now, technical indicators like the RSI are suggesting the stock is overbought, which, usually points to a short-term pullback. However, there's a really fascinating tug-of-war happening right now because the trading volume is just incredibly strong. Institutional investors are actively stepping in and buying the dips, and that's providing strong underlying support despite those overbought signals. And that brings us to a really critical crossroads for the immediate future. There are two distinct paths we're watching super closely over the next 2 to 3 trading sessions. Path 1, the stock breaks decisively through that $100 resistance level. If it does that, boom, the bull run is validated and it continues upward toward that 110 to 115 range. But then there's path 2. The stock rejects that $100 level. If we see a rejection, you can definitely expect some profit taking to kick in, and that will likely pull the price right back down to that $85 to $88 support zone. These next few days are absolutely critical. They're going to tell the market if this current momentum is a true breakout or honestly just a temporary fake out.
Which brings us to our final section, the final verdict.
Now, before we outline the analyst's final takeaways, just a quick reminder that this explainer is an educational data briefing, not personalized financial advice. Okay, based on the analysis, here is how the strategy breaks down. First, at these current stretched valuations, Marvell is really a buy-on-dips candidate. It's not a stock to just recklessly chase. If you're looking at the short term, patience is absolutely key here. Wait for a pullback to that $88 to $90 range before looking for an entry. However, if you're an investor with a longer 2 to 3 year horizon, the underlying AI networking story here is undeniably real. That makes this a core AI holding for the future. You just have to remember that the massive custom silicon payout is a 2027 catalyst, not a 2026 one. You literally have to be willing to weather that potential gap.
I want to leave you with this fantastic quote from our source material today. Marvell isn't the king of custom silicon yet, but it's the prince in waiting. The crown comes later. They have the revenue, they have the hyperscaler contracts, and they have the margin expansion. But they also have incredibly fierce competition from Broadcom and a really tricky timeline to navigate over the next couple of years. The pieces are absolutely all on the board. So the only question left is, do you think this prince has what it takes to eventually claim the crown? Thanks for joining me for this explainer. Keep asking the right questions.